The traditional starter home didn't just become expensive, it's almost obsolete. My wife and I bought our first home in 1994. It was about 1,200 square feet. Wasn't our dream house, but it was our first house. Today, first-time buyers are competing for a type of house that America's basically stopped building. And the explanation isn't as simple as blaming COVID, Wall Street, Airbnb, or older homeowners who aren't selling. Now, those things don't help any. The real problem began almost 20 years ago when the housing bubble burst and part of America's home building system collapsed along with it. Before the financial crisis, parts of the country were clearly overbuilt. Mortgage credit was easy. I saw borrowers with 560 credit scores getting 100% financing. Buyers were getting approved for loans they couldn't sustain. Investors were speculating. Seemed like everybody was becoming a builder. One day you're a roofer, next day you're building a spec home. I mean, crazy. Builders saw homes selling and assumed the demand would continue. But some of that demand wasn't real. It was being created by weak underwriting, adjustable rate loans, stated income loans, and the assumption that home prices would never stop rising. When the market collapsed, construction needed to slow down. The problem is, it didn't return to a normal level. It collapsed. Mortgage lending nearly froze. And I was working in the mortgage industry at the time, and I saw the difference before and after. Between 2007 and 2012, America lost roughly half the businesses primarily building new homes, from about 98,000 down to fewer than 49,000. Sometimes the borrower appeared to qualify, but the lender was struggling with funding, new overlays. All right, so overlays is like Fannie Mae has their own guidelines, and then a lender will come in and put their own rules on top of Fannie Mae's guidelines. So that's called an overlay. So it's a little more stricter. They also had fear that the loan couldn't be sold on the secondary market. So you also had builders and developers who were losing access to the construction financing too. Some of them had land that they had bought at the bubble prices. Some of them had unfinished subdivisions. Some of them had unsold spec homes that they were sitting on the books. A lot of the builders went out of business. Residential construction lost 1.5 million jobs, roughly. We're talking about framers, electricians, plumbers, roofers, a lot of skilled trades. When demand eventually returned, those workers in subcontracting businesses, they didn't just reappear. Many of them left and went into other industries or just left construction altogether. Banks took losses on development loans and became a lot more cautious about funding that next project. America didn't only lose the houses that weren't being built, it lost part of the system that builds houses. That's where the modern shortage begins. Now, some post-crisis regulation was necessary. The lending industry had practices that should have never existed. Some of the loan products that were being approved, I mean, they should have never been out there anyway. I mean, there were some crazy-ass loans that were being offered. But the response also created a much narrower credit box for the borrower. Lenders were concerned about the compliance, the legal exposure, especially legal exposure, the repurchase demands, and whether a loan would fit every new rule. A lot of lenders went beyond the official requirements and added their own restrictions. That's the overlays that I was talking about. The crisis created the initial shutdown. Regulation and lender fear helped make the recovery slower and more cautious. Construction eventually began recovering, but the industry that returned, well, it was different. There were fewer small builders. Development financing was harder to obtain. Skilled labor was limited. I mean, they were all gone. Buildable lots started becoming more expensive, and builders became more selective about what they were willing to build. I mean, for one thing, they weren't going to take on any more construction loans in their names. You better have your own financing because they just couldn't do it themselves. So this is where the numbers stopped working for the starter homes. A builder doesn't look at a piece of land and think, what's the smallest house a first-time buyer needs? The builder thinks, what can I build here that's going to give me an acceptable return for the cost and risk? Before the framing begins, the property already carries the cost of the land, surveys, engineering, legal work, zoning, subdivision approval, roads, drainage, water lines, sewer lines, utility connections, impact fees, permits, insurance, and finance. Man, that's a lot of costs. Take Charlotte, North Carolina. A finished buildable lot in a typical subdivision might cost somewhere between $60,000 and $110,000. Take $90,000 as a middle example. That includes the land and much of the neighborhood infrastructure. Depending on the development agreement, the builder may still owe individual water, sewer, permit, and connection charges before construction begins. Now, the exact amount changes by the project, but the point doesn't. The builder may already have close to 6 figures tied up before framing that first wall. If the land began as a raw subdivision, the developer also has to turn that land into finished lots. That means clearing, grading, the roads got to go in, the stormwater system, the retention ponds, utilities, and public improvements. The construction loan adds another cost. Now, construction loan rates were high back in the 1990s, but 10% on a $100,000 project is still fewer interest dollars than 8% on a $350,000 project. Today, the builder may be financing more expensive land. They got higher fees, higher material costs, higher labor costs, and more expensive infrastructure. Every delay adds interest, and that cost eventually reaches the buyer. Now, consider the 1,200 square foot starter home. The house may use less lumber, less flooring, smaller HVAC system, and fewer cabinets. But the road doesn't cost half as much. The sewer line doesn't cost half as much. The engineering, legal work, utility connections, and the approval process, that doesn't fall by half. Even some impact fees are the same whether a builder puts a 1,200 square foot home on the lot or a 3,000 square foot home on the lot. That fixed cost is much harder to absorb in a lower priced house. Once a builder already has a large amount of money tied up in the finished lot, the incentive is to put more value on top of it. That means more square footage, an extra bathroom, better finishes, or features that raise the final price. Now, people often say builders only construct expensive homes because they're greedy. Well, builders are trying to make money. But greed doesn't fully explain the decision. The system frequently makes a small starter home the least attractive product to build. Builders can remove granite countertops, the expensive trim, and upgraded appliances, and that may reduce the price. But cosmetic changes don't eliminate the land, roads, utilities, fees, labor, and financing costs already attached to the property. The country didn't only lose affordable houses, it lost affordable finished lots. Then COVID arrived. COVID didn't create the shortage. It hit a market that had already failed to build enough homes for more than a decade. Mortgage rates fell to historic lows. Buyers could borrow more without immediately increasing the monthly payment. Remote work changed where people wanted to live. Demand moved into suburban communities and lower-cost cities. Homeowners refied into rates near 3%, sometimes less. I saw clients refi into extremely low rates, improve their monthly cash flow, and then buy another property as a rental or Airbnb. At the same time, construction faced supply chain issues, labor problems, permit delays, and sharply higher material costs. Demand increased while the cost of creating new supply also increased. Prices got jacked up on houses. Then mortgage rates rose. Now, normally, higher rates should reduce demand and push prices down. But something else happened. Millions of homeowners had already locked in super low fixed rates. A homeowner with a 3% mortgage, well, they may want to move, but replacing that loan with a higher rate can produce a far larger payment, even if the next house isn't much more expensive. So they stay. The family that would have moved into a larger house keeps the starter home. The older homeowner who might have downsized stays in the larger home. During the low rate period, some owners moved, but they kept the starter home as a rental. After the rates rose, other homeowners, they just stopped moving altogether. Different decisions, but the same result. Fewer starter homes returned to first-time buyers. The normal housing ladder just stopped moving. That's why today's market isn't just expensive, it's frozen. Now, let's look at who usually gets blamed, because most of these explanations contain some truth, but they just don't explain the whole problem. The first claim is that Wall Street bought 25% of America's homes, but that's not what the stat means. In some periods, investors of all sizes purchased roughly 1/4 of homes. But the word investor includes an individual buying one rental, a couple buying an Airbnb, a local landlord, a flipper, a small LLC, a second home buyer, and a large institution. Large institutional investors were only a fraction of that total nationally. But the opposite claim, that institutions are too small to matter, well, that's also misleading. Housing is local. Large investors concentrated their purchases in certain cities, neighborhoods, and price ranges. They targeted places like Atlanta and Charlotte, where there were a large number of similar low-priced homes and strong rental demand. If an institution buys heavily in the neighborhood where you're trying to buy, well, the national percentage doesn't mean squat to you. So the accurate description is nationally limited, locally significant. That also explains why saying private equity created the national shortage, well, that goes a little too far. Large investors entered the market after the financial crisis produced foreclosures, discounted homes, damaged household credit, and very little competition from ordinary buyers. They took advantage of the conditions created by the crisis. And I saw how quickly some of these distressed pockets recovered. In one townhome neighborhood near me, a unit sold for $79,000 after the crash. Less than 2 years later, a similar unit in that neighborhood sold for $129,000. Investors with available capital were positioned to capture that rebound, while many of the former homeowners were still repairing their credit. In some areas, they made it harder for first-time buyers to even compete. But that didn't cause builders to stop producing homes after 2008. They added pressure to a shortage that already existed. Airbnb works the same way. It didn't create the national housing shortage, but it can be a major local problem. In tourist communities, coastal areas, downtown neighborhoods, and resort markets, short-term rentals can remove a meaningful supply from both home buyers and long-term renters. I saw this firsthand in downtown Savannah, Georgia. Clients weren't just buying one Airbnb, they were actively looking for more. Someone living in one of those communities may reasonably believe Airbnb is the main problem because that's what they see around them. Their local observation can be correct without explaining the entire country. This is the distinction between a local problem and a national explanation. The local view is what happens in your neighborhood or in your city. The national view is what explains the broader shortage. That answer includes the collapse in construction after 2008, the loss of builders and trades, expensive land and infrastructure, weak starter home production, COVID cost increases, and today's mortgage lock-in. A local cause can be real without being the national root cause. Another common claim is that young people can't buy because they spend too much. Well, I spent years counseling people whose car payments, credit card debt, weak credit, or lack of savings absolutely prevented them from qualifying for a mortgage. So personal decisions do matter, and I don't think anybody's going to argue that point. But financial discipline can also make someone ready to buy. But it can't make a builder produce a 1,200 square foot home. It can't lower the cost of land. It can't create more listings. And it can't turn a $400,000 home into a $250,000 home. So what could improve the situation? Well, the central answer isn't giving buyers more money to bid on the same limited number of homes. Down payment assistance can help an individual buyer, but it doesn't create another house. Lower mortgage rates could improve the payment, but if supply remains tight, lower rates, well, that's just going to push prices higher. So that's out. The real answer is making modest housing financially worthwhile to produce. And Houston has already proved that this can work. In 1998, Houston reduced its minimum lot size inside the loop from 5,000 square feet to as little as 1,400 square feet. The city expanded that change more broadly in 2013. From 2007 to 2020, the reform helped enable more than 34,000 townhomes because builders could divide the land cost among more buyers. Houston didn't make the land or labor cheaper. It changed what a builder was allowed to put on a piece of land, and the builders responded to that incentive. That same mechanism could apply elsewhere. Smaller lots, townhomes, and cottage developments that spread land and infrastructure costs across more homes. Impact fees scaled by square footage instead of charging a flat fee. Faster approvals for starter home plans. Now, none of these are the complete answer by itself. The federal government can help by supporting housing production, infrastructure, small builders, manufactured housing, and regulatory reform. And there's been a major development on that front. In July 2026, the 21st Century Road to Housing Act became federal law. It addresses barriers such as permitting delays, development fees, minimum lot sizes, parking requirements, and manufactured housing. But it doesn't override local zoning, and that's kind of a big deal. Many of the most important decisions still belong to states, cities, and counties, including lot sizes, impact fees, utility costs, road standards, and approval times. So Congress has acknowledged the supply problem. Unfortunately, buyers just probably aren't going to see an immediate fix. There's also a structural tension here. The same scarcity that makes housing expensive to buy also makes existing homes more valuable to the people who already own them. That's not a coincidence. It's an incentive problem. And it's part of why a fix like Houston takes real political will to pass anywhere else. The 1,200 square foot house that my wife and I bought in 1994 wasn't unusual. It's how a lot of families got started back then. Today's first-time buyers still want that first rung. The problem is that the economics of building it, and increasingly the economics of reselling it, stopped working.